Today, one of the largest banks in the world released a silver price target that should make anyone paying attention stop and rethink everything they believe about this market. Not $100, not $120. They are calling for a move toward $135 in a standard continuation scenario, and potentially as high as $309 per ounce if conditions tighten the way historical patterns suggest they can. That is not exaggeration. That is not hype. That is a projection built on ratio mathematics that has already played out before in previous precious metals cycles. The head of metals research laid out a framework based on historical gold to silver ratio compression. And when you apply that framework to today's gold price near $5,000 per ounce, the implications for silver become mathematically unavoidable. In this analysis, I'm going to walk you through every piece of that thesis, from the ratio mechanics to the persistent supply deficits, from China's aggressive restocking behavior to Mexico's production instability, and finally, the professional positioning strategies traders use when they expect asymmetric upside. By the end, you won't just understand the numbers, you'll understand the structure behind the call. Before going further, let me make something absolutely clear. I don't sell courses, I don't sell signals, I don't run paid groups or premium memberships. If anyone contacts you asking for money while pretending to represent this analysis, that is a scam. Block them immediately. The only purpose here is to break down institutional research in a way that makes sense, because understanding how markets actually function gives you clarity when headlines create confusion. Now let's start with the core of the thesis, the gold to silver ratio. The ratio currently sits near 59 to 1. That means it takes roughly 59 ounces of silver to purchase 1 ounce of gold. With gold trading near $5,000 per ounce, we can calculate silver's potential price simply by applying historical ratio levels that have occurred before. During the previous major bull market in precious metals, the ratio compressed to 32 to 1. That compression coincided with silver dramatically outperforming gold during the late phase of that cycle. If you apply a 32 to 1 ratio to a $5,000 gold price, the implied silver value would be approximately $156 per ounce. The 135 base case target is actually conservative compared to strict ratio math. Now consider the more extreme historical reference point. In 1980, during the most intense silver squeeze in modern history, the gold to silver ratio compressed all the way to 14 to 1. Applying that ratio to $5,000 gold results in a silver price of approximately $350 per ounce. The higher-end projection of $309 is again conservative relative to the raw mathematical output. These targets are not fantasy. They are simply the product of historical ratio compression applied to today's gold environment. Some will argue that the 1980 squeeze was unique, driven by specific circumstances unlikely to repeat. And while the exact personalities involved may not return, the structural dynamic behind that squeeze absolutely can. When physical supply tightens and demand accelerates simultaneously, price moves do not follow linear trends. They accelerate, they overshoot, they spike. Understanding ratio compression is critical. In early stages of a precious metals bull market, gold typically leads. It establishes momentum. It attracts institutional capital. It captures headlines. Silver follows but lags. The ratio remains elevated. Then, as gold's move becomes widely recognized, investors look for relative value. They notice silver hasn't moved proportionally. They notice the ratio sitting at historically elevated levels. Buying begins. As momentum builds, silver outperforms gold at a faster rate, and the ratio compresses sharply. We saw this clearly in the prior cycle, when silver more than tripled in roughly 18 months, while gold gained substantially less in percentage terms. Silver's outperformance was not random. It was driven by ratio normalization. Today, gold has already moved from lower levels to nearly $5,000. That establishes the first phase of the bull market. The ratio remains elevated near 60. That sets the stage for the second phase, where silver catches up aggressively. The $135 target assumes orderly continuation. No panic, no squeeze, just historical pattern repetition where silver converges toward gold through natural compression. The 300 scenario, however, implies something more dramatic. It implies either a liquidity event, a delivery squeeze, or a surge in physical demand that overwhelms paper markets and forces price discovery to shift toward physical scarcity. And that brings us to the supply picture, because this is where the thesis becomes fundamentally compelling rather than purely mathematical. The silver market recorded its 5th consecutive year of structural deficit. Demand exceeded supply by approximately 95 million ounces last year alone. Since 2021, the cumulative deficit has now surpassed 820 million ounces. To understand the magnitude of that number, consider global annual mine production, which sits near 813 million ounces. In other words, the cumulative shortfall over recent years equals more than an entire year of global mining output. That silver did not disappear into thin air. It was absorbed from above-ground stockpiles, vault inventories, ETFs, and private holdings. And once those inventories are drawn down, they cannot be instantly replaced. Mining projects require years to develop, permit, finance, and construct. Even if prices doubled immediately, meaningful new supply would not enter the market quickly. Projections indicate another deficit year ahead. That means additional inventory drawdowns. Mine supply has plateaued with no significant surge expected. The supply response to higher prices is slow due to geological limits and regulatory complexity. Meanwhile, demand is not discretionary. Solar installations have reached record levels and continue accelerating. Every photovoltaic panel requires silver for conductive applications. There is no scalable substitute that performs equivalently. Electric vehicles require silver throughout battery systems and electrical components. As EV adoption expands globally, demand increases accordingly. Advanced communication systems, semiconductor fabrication, and data infrastructure supporting artificial intelligence also rely on silver for conductivity and reliability. Investment demand compounds industrial demand rather than replacing it. Western physical investment is forecast to rise significantly as retail participants who missed previous rallies re-enter the market. This demand stacks on top of industrial consumption. So the key question becomes simple. Does silver at current levels accurately reflect 5 consecutive deficit years, over 820 million ounces of cumulative shortfall, accelerating industrial demand, constrained mine supply, and rising investment flows? That is the question institutional analysts are examining, and that is only the foundation of the thesis. Now let's expand beyond the structural deficit numbers and move into the geopolitical and operational variables that could accelerate this imbalance far beyond what current pricing suggests. Because when you combine tight fundamentals with strategic behavior from major global players, markets can transition from gradual appreciation to sudden repricing events. 2 developments stand out right now, and both have the potential to materially alter the silver supply landscape. First, China. China is the largest consumer of silver globally, and its industrial base depends heavily on stable access to raw materials. Following the Lunar New Year period, there has been a noticeable increase in restocking activity across key metals, including silver and copper. This is not routine inventory turnover. This is deliberate supply chain positioning. China has consistently demonstrated a willingness to secure critical inputs in advance when it anticipates volatility, inflation, or geopolitical stress. Precious metals are not viewed purely as commodities within that framework. They are treated as strategic resources. When China accelerates purchases, it does so for multiple reasons. It hedges currency risk, it insulates domestic manufacturing from price spikes, it secures supply continuity for sectors like electric vehicles, renewable infrastructure, and advanced electronics. And most importantly, it reduces vulnerability to external disruptions. When the world's largest silver consumer increases restocking during a period of structural deficit, that is not a neutral data point. That is forward-looking behavior based on internal projections of tightening supply conditions. Second, Mexico. Mexico accounts for roughly 1/4 of global silver production, approximately 200 million ounces annually. That concentration creates geographic risk. A significant portion of Mexican mining output comes from regions impacted by cartel-related violence and organized crime activity. This is not speculation. Mining operations operate under security constraints. Transportation corridors can be vulnerable. Personnel safety risks increase operating costs and reduce flexibility. Even minor disruptions can create ripple effects in global supply chains. If instability escalates, logistical disruptions could materially reduce export flows. Even without dramatic escalation, persistent instability raises risk premiums, discourages new capital investment, and complicates expansion efforts. Mining is capital-intensive and long-cycle. Investors require stability. Uncertainty delays projects. Delayed projects limit future output growth. When the largest producing country operates under structural tension, supply expansion becomes far less predictable. Now consider these 2 dynamics together. The largest consumer is increasing strategic stockpiling. The largest producer operates under security friction that constrains expansion. Overlay that with 5 consecutive deficit years and declining above-ground inventories. That combination is precisely the environment where price acceleration can occur. Adding further complexity, one of the world's largest primary silver producers recently reduced its forward production guidance. The revised projection lowers expected output by several million ounces compared to prior estimates. While this may seem modest in isolation, incremental reductions matter when the market is already in deficit. Each downward revision tightens the margin between supply and demand. Each shortfall increases reliance on inventory drawdowns. The timeline to bring new mines into production spans many years. Exploration, permitting, environmental review, financing, construction, and operational ramp-up require patience and capital. Even in a favorable price environment, Production growth does not respond immediately. This lag creates a structural rigidity on the supply side. Demand can rise rapidly. Supply adjusts slowly. Now let's discuss how professional traders approach this type of asymmetric setup. Institutional participants rarely rely on simple directional bets. They structure positions with defined risk parameters. One common approach involves utilizing standardized futures contracts. These contracts allow traders to control a larger notional silver exposure with a smaller capital commitment compared to purchasing equivalent physical metal outright. For example, a 100-ounce silver futures contract provides exposure to price movement across the full notional value of that metal. Margin requirements typically represent a fraction of total value, often between 5 and 10%. This creates capital efficiency, but also introduces leverage risk. Professionals mitigate that risk by scaling into positions across multiple price levels rather than committing capital all at once. Imagine acquiring exposure at $90, adding more at $82, and further at $71. This method averages cost across volatility rather than attempting to time a precise bottom. If silver rallies toward higher targets, the cumulative position benefits. If price declines, predefined stop levels limit losses. Every dollar movement in silver directly impacts profit or loss proportionally to contract size. Another structured method involves option strategies. One frequently discussed tactic is a bull-call spread. In this structure, a trader purchases a call option at one strike price while simultaneously selling another call at a higher strike. The purchased call provides upside exposure. The sold call caps maximum gain but reduces upfront cost. The result is a defined risk position where maximum loss equals the premium paid and maximum gain is predetermined. For example, purchasing a call at $130 and selling one at $140 creates a profit window if silver closes above the higher strike. While this caps upside beyond that level, it dramatically improves risk-to-reward efficiency. Institutional traders often favor such defined structures because they allow participation in upside scenarios without unlimited downside exposure. The key principle behind both approaches is controlled exposure. Professionals assume volatility. They assume pullbacks. They do not assume linear appreciation. They build positions that survive interim turbulence while retaining asymmetric upside if the thesis unfolds. Now let's outline two possible forward paths. In the bullish case, the sixth consecutive deficit further drains inventories. China continues accelerating restocking efforts. Mexico experiences logistical friction or reduced output. The gold-to-silver ratio begins compressing gradually. 55 becomes 50, 50 becomes 45. As compression continues, silver's percentage gains outpace gold. Investment flows increase as momentum attracts new participants. Exchange inventories decline to levels that raise delivery concerns. Physical premiums widen. Paper markets struggle to reconcile pricing with available metal. In this scenario, $135 becomes a midpoint rather than a ceiling. In the alternative case, macroeconomic pressure slows industrial demand. Solar installation growth moderates. Electric vehicle adoption decelerates temporarily. China pauses restocking while working through existing reserves. Mexico maintains stable production. Monetary policy remains restrictive. The dollar strengthens. Precious metals experience headwinds from higher real yields. Under this outcome, silver consolidates within a broad range while deficits narrow gradually. Both paths remain plausible. Markets rarely move in straight lines even when structural fundamentals appear supportive. Timing matters. Volatility tests conviction. The difference between being correct and being profitable often lies in position sizing and patience. The central observation remains unchanged. Structural deficits persist. Inventory buffers shrink. Demand from solar, EVs, advanced electronics, and investment channels remains durable. Major institutions are publishing ratio-based price projections grounded in historical precedent. And strategic behavior from key global players suggests preparation for tighter supply conditions rather than relief. Now let's bring this together by examining what signals matter most going forward, because once a thesis becomes widely discussed, the difference between theory and execution lies in tracking confirmation. Large price projections attract attention, but confirmation emerges from observable market behavior. The first metric worth monitoring is the gold-to-silver ratio itself. If the ratio begins a sustained decline from near 59 toward 55, that would represent early evidence of compression. A decisive move below 50 would indicate that silver is beginning to outperform meaningfully. Should the ratio approach the low 40s, historical analogs suggest late-stage bull dynamics could be unfolding. The ratio is not just a statistic. It reflects capital rotation within the precious metals complex. The second key indicator involves exchange inventories, particularly registered deliverable silver. Registered supply represents metal available to settle futures contracts. Persistent drawdowns signal tightening physical conditions. If registered inventories decline while price remains firm, that divergence can precede repricing events. Conversely, unexpected increases in deliverable supply could ease immediate pressure and delay acceleration. Premiums in major physical markets also provide insight. Elevated premiums often reflect immediate demand outstripping accessible supply. When buyers are willing to pay above benchmark pricing to secure metal, it suggests stress within distribution channels. Narrowing premiums indicate improved availability. Watching these signals alongside inventory data builds a clearer picture of physical conditions beyond headline futures prices. Producer guidance remains critical. Further downward revisions from major miners would reinforce the constrained supply thesis. Upward revisions would challenge it. Production consistency matters when the market operates within structural deficit territory. Even marginal changes in output can influence expectations when inventories are already depleted. Investment flows represent another layer of confirmation. Expanding holdings in precious metals, funds signal growing participation from capital pools that amplify trends. Outflows suggest caution or profit-taking. When institutional participation aligns with tightening physical conditions, price acceleration often follows. Now let's address psychology, because large projections test emotional discipline. When you hear a number like $309 per ounce, the instinctive reaction is skepticism. The mind anchors to recent experience. Silver traded near $20 for years. It moved to $30, then $50, then $75, now near $94. Each level once seemed unlikely. The human brain resists exponential projections because they appear disconnected from lived experience. Yet markets do not move according to comfort levels. They move according to supply, demand, liquidity, and capital flows. Ratio math does not rely on belief. It relies on division. If gold remains near $5,000 and the ratio compresses toward historical norms, silver's corresponding price follows automatically. At 32 to 1, silver approximates $156. At 14 to 1, it reaches far higher. Whether those levels feel plausible is irrelevant to the arithmetic. The real question is whether conditions exist for compression. Given persistent deficits, inventory erosion, and expanding structural demand, the ingredients are present. Volatility complicates conviction. Silver recently experienced a sharp correction from higher levels down toward the mid-70s before recovering. Such movements can shake confidence and prompt doubts about broader projections. But volatility within bull markets is common. Sharp pullbacks often reset positioning rather than invalidate structural trends. The speed of recovery after declines can provide clues. Rapid rebounds suggest underlying demand remains intact. Risk management remains essential. Even strong theses encounter adverse periods. A global recession could temporarily reduce industrial demand. A stronger dollar environment could pressure commodity pricing. Monetary tightening could dampen speculative flows. These risks do not erase structural deficits but can delay realization of higher price targets. Position sizing becomes critical in environments where timing is uncertain. Over-leveraged positions amplify stress during pullbacks. Options introduce time decay risk. Futures require margin discipline. Physical ownership eliminates counterparty exposure but ties up capital and limits flexibility. Each vehicle carries advantages and trade-offs. The appropriate choice depends on individual risk tolerance and time horizon. Defined risk strategies often provide balance. Scaling into positions across volatility allows cost averaging without reliance on perfect timing. Structured options spreads capped downside exposure while preserving upside participation. Maintaining liquidity reserves enables flexibility during unexpected declines. Planning exit criteria in advance prevents emotional decision-making under pressure. Let's revisit the foundation of the thesis. Major institutional research suggests a range of $135 in a base case scenario and as high as $309 under compression dynamics. These projections derive from historical gold to silver ratios applied to today's gold pricing. The historical record shows compression to 32 to 1 and even 14 to 1 in prior cycles. Current supply-demand conditions include 5 consecutive years of structural deficit, cumulative shortfalls exceeding annual global production, plateaued mine output, constrained project pipelines, and durable industrial demand from solar, electric vehicles, advanced electronics, and emerging technologies. Strategic restocking behavior from the largest consuming nation reinforces forward-looking tightening expectations. Concentrated production in regions facing operational risk introduces supply uncertainty. Downward revisions from major producers reduce margin for error. Western investment demand is projected to rise, adding incremental pressure. The combination of ratio mathematics and structural fundamentals creates asymmetry. If compression occurs gradually, the base case becomes achievable. If compression accelerates due to physical tightness, higher targets move into focus. If macroeconomic headwinds intervene, consolidation may persist before eventual resumption. Ultimately, markets determine outcomes. Institutional projections are not guarantees. Analysts revise targets as conditions evolve, but understanding the analytical framework behind these projections allows you to evaluate them independently. Rather than reacting to headlines, you can assess inventory data, ratio movements, production updates, and investment flows. The broader context also matters. Many analysts describe the current environment as part of a broader commodity supercycle driven by underinvestment in resource development and long-term structural demand growth. Silver sits at the intersection of monetary and industrial forces. It functions as both precious metal and essential industrial input. That dual role amplifies volatility but also broadens demand channels. If gold maintains strength near current levels, ratio compression remains the central mechanism. If gold extends higher, silver's implied targets rise proportionally. If gold stalls, compression potential narrows. Watching gold's trajectory therefore remains integral to silver's outlook. In the end, the question is not whether large numbers sound dramatic. The question is whether the structural data supports the possibility. 5 consecutive deficit years, cumulative inventory depletion exceeding annual production, constrained supply growth timelines, strategic stockpiling by major consumers, and historical ratio precedents form the basis of the argument. Markets will fluctuate, pullbacks will occur, sentiment will swing between optimism and doubt, but structural forces move slowly and persistently. When deficits endure for multiple years and inventories thin, price eventually adjusts. Whether that adjustment unfolds toward 135, toward 309, or consolidates before continuing higher depends on macro variables, monetary conditions, and timing. But the analytical foundation remains grounded in arithmetic and observable supply-demand dynamics rather than speculation alone. Approach this market with discipline, evaluate the data, align position size with risk tolerance, recognize volatility as inherent rather than exceptional, and monitor the ratio, inventories, production guidance, and investment flows as primary signals. Silver's trajectory from here will not be determined by opinion, but by mathematics and metal availability. The structure is in place. The deficits are real. The ratio history is documented. The rest is execution and patience.